Friends, now it's time for us to complete chapter number 12, standard costing. And we have the last question in the exercise part, that is question number 6 in page number 12.55. So I request all of you to pause the video and read the question once. Okay, so I hope you all have got the question. Now, let's see what are the salient features that are given information given in the question. Okay, now so what's given here? T-Tech is a Taiwan-based firm. So what is the name of the company? T-Tech. And this is a Taiwan-based firm. Now, what does this company do? This company designs, develops and sells audio equipment. Now, founded in 1975 by Mr. Bose, the firm sells its products throughout the world. T-Tech is best known for its home audio systems and speakers, noise cancelling headphones, then professional audio systems and automobile sound system. Now, extracts from the budget are shown in the following table. And you have a budget with respect to home audio system division. Okay, so this company has got a particular division which is known as the home audio system division, and you have the certain information regarding this system for the month of Jan 2019. Okay, now what all information do you have here? Okay, now the system, there are two types of home audio systems. One is 3000 watt PMPO and the other one is 5000 watt PMPO. Okay, so two models, and the sales units for the first model that is given. Now this is the extract from the budget. Okay, so this is the budgeted sales units, then budgeted selling price, then they have given you the standard cost per system also. Okay, for each of these two models. Now the managing director has sent you a copy of an email he received from the sales manager, Mr. K. The content of the email was as follows. Okay, so the sales manager has given you sent the managing director some email, and as far as the managing director is concerned, he wants you to evaluate whatever email the sales manager has sent. So obviously it has to be something related with what the costing. Okay, now let's see what is the content of the email. Now we have had an outstanding month. There was an adverse sales price variance on the 3000 watt PMPO systems of rupees 22,50,000, but I compensated for that by raising the price of 5000 watt PMPO systems. Okay, so what is the information given here? So Mr. K, the sales manager, is stating that the company had an outstanding month, means a wonderful month, means the company has done wonderfully well for that particular month. Okay, now there was an adverse sales price variance on 3000 watt PMPO systems. Okay, so what's given here? The sales manager says that there was sales price variance. Sales price variance. What is the sales price variance? Sales price variance is the variance on account of variation or difference in the budgeted selling price and actual selling price. The difference between budgeted selling price and actual selling price. If the budgeted selling price or if the actual selling price becomes higher than the budgeted selling price, then it is going to be a favorable variance, and on the other hand, if actual selling price is lower than the budgeted, then it is going to be an adverse variance. Okay, right. Now what the sales manager says is, he say that with respect to 3000 watt, so 3000 watt model, okay, what is the variance? Variance was an adverse variance of 22,50,000. So rupees 22,50,000 adverse means what? The actual selling price of 3000 watt model was lower than what the budgeted selling price. Okay, that is the inference. Now he says that he could compensate this adverse variance by raising the price of 5000 watt PMPO systems. Okay, wonderful. So he knew that on one side the selling price, the actual selling price of 3000 watt PMPO were lower than the budgeted. But what he did to compensate that loss, he increased the selling price of 5000 watt PMPO systems. Okay, he increased the selling price of 5000 watt PMPO so as to offset the adverse variance on account of the first model with the favorable variance in the second model. Okay, so in 5000 watt model, he had same variance 22,50,000, but it was a favorable variance. So on net, it will be a nil variance. Okay, so on not net basis, there is no sales price variance. That is what Mr. K has conveyed. Okay, now next, unit sales of 3000 watt PMPO systems were as expected, but sales of 5000 watt PMPO were exceptional and gave a sales margin volume variance of 23,75,000 rupees. And he also states that he thinks that he deserves a bonus. Yes. So this is sales price variance. Now there is one more variance in sales. Okay. What is that? Sales volume variance. Okay. So what he says that with respect to sales margin volume variance. Okay. How does the sales volume or sales margin volume variance arises? This is the difference in the budgeted sales quantity and actual sales quantity. Is it clear? Not standard quantity, sales quantity. Okay, now he says that unit sales of 3000 watt PMPO systems were as expected, which means in the case of 3000 watt PMPO, there is nil variance for sales volume variance, nil sales volume variance. But he says that sales of 5000 watt model, 5000 watt PMPO or model was how much? 23,75,000 favorable. Why do you say that it is favorable? He says that the sales of 5000 watt of PMPO were exceptional. Means what? When he says that it was exceptional, we can assume that it is going to be an increase in the sales quantity. Why? Because next sentence he also says that he thinks he deserves a bonus. When he will ask you for a bonus, he will ask for a bonus only if he has performed well. So here on the first part, the sales price variance is almost nil when you offset the adverse variance with the favorable variance in the models. But in respect of the volume variance, there is no variance with respect to 3000 model, but there is a variance which is favorable variance in respect of 5000 model, and the amount is rupees 23,75,000 favorable. Okay, so he says that on net basis he got a favorable variance of 23,75,000, and that is why he thinks that he deserves a bonus. Okay, and now the managing director as usual has asked for the opinion of the cost accountant, and this mail and the figures has been forwarded to you, and you got some information from the department. Okay, that is the actual results for Jan 2019, actual results. Okay, so you are comparing the budgeted results with actual results. Let's see what is the information available. Now they say that in case of 3000 watt model, sales units is 1500 units. Okay, sales units is 1500. How much is the budget? The budget is also 1500. That is why who said the Mr. K said that as far as 3000 model is concerned, there is no variation because they budgeted 1500 and they got how much? 1500 itself. And in case of 5000 watt PMPO, how much you budgeted? You budgeted 500. And how much you got? Actual sales was 600. Yes, that is why he says that he could sell 100 units more. Okay, when he sells 100 units more, then he is getting a favorable quantity or volume variance. Is it clear? Volume variance. Now, what is the further information? The total market demand for 3000 watt PMPO systems was as budgeted. Total market demand means what? Market size. It is something which indicates the market size. Okay, market size. So market size of 3000 watt model was same as it was budgeted. There is no change in the market size. But as a result of suppliers reducing the price of supporting Ultra HD TV system, the total market for 5000 watt PMPO systems raised by 50% in Jan 2019. Yes, that is the crucial information. Okay, he says that the market information says that the overall market size of 5000 model PMPOs or 5000 model audio systems has increased by 50%. Okay, so the increase in the market size for 5000 watt model is 50%. Okay, now the company had sufficient capacity to meet the revised market demand for 750 units of this 5000 watt PMPO systems and therefore maintain its market share. Okay, so what's happening? The company had a sufficient capacity to meet the revised market demand. What is the revised market demand? 750 units for 5000 PMPO. Why revised market demand? Because original budget was prepared with some market size. Okay, now in actual what happened? The market size grew by how much? 50%. So when the market size grew by 50%, what you have to do? You have to revise the original budget. Am I right? Because any change in the market size is not something which is in the control of whom? The sales manager. Okay, whether it is increase or decrease, you can't blame whom? The sales manager for any change in the market size. Is it clear? So if there is any favorable or adverse impact on account of change in the market size, then it cannot be taken to be something which is under the control of the sales manager, but it has to be taken as something which is beyond the control of the sales manager, and such things or such variances which is beyond the control of the sales manager is what is known as planning variances. Okay, if you remember, we had learned about planning and operational variances. Okay, so what is happening here is you have an original budget and that original budget have to be revised when there is a drastic change in the market size. Okay, and the difference between the original budget and the revised budget is something which leads to what? Planning variance, and not anything which is leading to operational variance. Okay, we have already discussed the difference between planning variance and operational variance, and so I am not going into those details in those specifics in detail. Okay, so you can write a note. Okay, note. It's given that one minute. Okay, we'll continue. So it's given that the market size for 5000 watt PMPO has increased by 50%. Okay, now this increase in the market size and the consequent and the resultant variance is something which is beyond the control of the sales manager. Okay, next paragraph. Accordingly, the company has to revise its original budget original budget in line with what? The revised market share. Market share. Okay. Any variance or difference. Any variance or difference due to variation in the original budget and the revised budget will lead to what variance? Planning variance. Okay, you can add one more sentence. The sales manager cannot be held accountable for any amount of planning variance. Is it clear? Okay, so first we have to identify what is the planning variance, and you take that planning variance out of question, out of this picture, because you can't keep your sales manager accountable or responsible for any planning variance. Okay, now to prepare the planning variance, what do you need? You need to prepare a revised budget. Okay, now how to prepare the revised budget? You can write the heading, preparation of revised budget. Due to variance in market size. Okay, you can write what? You can have the original budget, quantity, then revised budget. This is also quantity. The first model is 3000 watt PMPU. Okay, what was the original budget for this? Original budget was 1500 units. Okay, then 5000 watt PMPO, 5000 units. And what is the change that has happened? They say that there is no change in the 3000 watt PMPO market size. The only change in market size is on account of the model 5000 watt model, and this model market share has increased from 5000 to 750 units. That is the last sentence what they are giving. Okay, the company had sufficient capacity to meet the revised market demand for 750 units. So the revised budget should be 750 units. Is it clear? And what about 3000? That will be 1500 itself. There won't be any change in that. Is it clear? So this is the revised budget, and the variation on account of this, okay, will lead to what? Planning variance. Is it clear? Okay, now let's see what is the requirement of the question. Okay, what is the requirement? The first requirement is to calculate the following operational variances based on the revised market details: sales margin mix variance, sales margin volume variance. Okay, if you remember, then you know that the sales margin variance, sales margin variance has been divided into two: sales price variance, of course sales margin price variance, and sales volume variance, right? Now sales volume variance itself you can divide into two if you have a multi-product situation or if you are selling more than one product. What is that? Sales margin mix variance, and the balance will be sales margin quantity variance. Okay, now sales margin, we initially itself we know that there are two types of variance: planning variance and operational variance. So here the requirement is to compute the operational variance, that too only two variances, which are the sales mix variance and what else? Sales volume variance, sales margin volume variance. So these two you have to compute. Okay, now sales price variance they are not asking you to compute. Why they are not asking you to compute? Because it is already given that sales price variance is nil, because there was adverse variance in the first model, but the adverse variance in the first model on account of changes in the sales price was actually compensated by the increase in the selling price of the second model, that's 5000 watt model. Okay, so this will be nil. Okay, so you can write a not to that extent, not as the adverse variance on account of sales margin price variance, on account of sales margin price variance in 3000 watt PMPO, in 3000 watt PMPO was offset with favorable variance in 5000 watt PMPO models, 5000 watt PMPO models, comma, the net sale price variance is nil. Is it clear? It has become nil. Okay, now therefore you can continue. Therefore we need to compute only the sales margin volume variances. Sales margin volume variances. Is it clear? Okay. Now the question is how to compute the sales margin variances. Okay, right. So first thing is you have already computed the revised budget and the actual budget. Now what do you have to do? You have to find out what is the standard margin. Okay, because whatever you are calculating here is the margin variance. Okay, so computation of standard margin. Okay, now how can you compute the standard margin? Standard margin has to be computed on the basis of by reducing the standard cost from the budgeted selling price. Okay, so standard margin is equal to what? Budgeted selling price per unit minus standard cost per unit. Okay, now you have 3000 watt PMPO. What is the what do you call the budgeted selling price? The budgeted selling price was 18,750. 18,750 rupees. 18,750 minus how much? Standard cost per system is 12,500 rupees. 12,500. So what is the difference? The difference is rupees 6,250. Difference is rupees 6,250 per system. Is it clear? Okay. Now similarly, you can compute the standard margin for 5,000 watt PMPO, and what will be the amount? The amount will be the difference between what selling price and the standard cost. Selling price is how much? 50,000 minus what is the standard cost? 26,250. 26,250. So 50,000 minus 26,250 will be how much? Okay, it will be 23,000. rupees 23,750. Rupees 23,750. This is the standard margins. Okay. Now you can compute the volume variance first. First you can compute the volume variance, then go ahead with the mix variance and quantity variance. But before that, you have to first bifurcate what? Bifurcate the planning variance. Okay. So let me find out the planning variance first. Computation of planning variance. I am not writing what is the meaning of planning variance and all, because we have written it in detail. Okay. So computation of planning variance, and in planning variance, again, there is no revision in the selling price per unit when you prepare the revised budget. Okay. So there won't be any price variance in planning variance. Okay. So you can write a note: no revision in selling price per unit when the revised budget was prepared. Revised budget was prepared. Okay. Hence, there will not be any sales price planning variance. Sales price planning variance. Is it clear? Okay. So the variance will be only with respect to what? The volume planning variance. Okay. So planning variance hyphen sales volume variance. Okay. Sales volume variance, how can you compute that? Okay. You have to check the original budget and revised budget. Where is original budget and revised budget? Original budget and revised budget, there is no difference in the quantity with respect to the 3000 watt model. The only difference is with respect to 5000 watt. Okay. So you have to compute that only. Now sales volume variance 3000. So you can write the formula if you want. The formula will be sales volume variance is difference between original budgeted quantity minus revised budgeted quantity into standard margin. Okay. Now 3000 watt PMPO. Original budgeted quantity. How much was the original budgeted quantity? It is 1500 itself. Okay. So 1500. And revised budgeted quantity, we have the revised budget here, that is also 1500. 1500 multiplied by what is standard margin in the first case? 6250. 6250. So tell me what would be the amount? The amount will be nil. Clear? Then next, 5000 watt PMPO. What is the amount here? The original budget was how much? 500, and it was increased to 750 into what is the standard margin? Standard margin is 23,750. 23,750. So what is the amount? The amount will be 250 into 23,750, and that will be rupees 5937 500. Tell me, is it a favorable variance or adverse variance? It is a favorable variance. Why favorable variance? The market size has increased and the budgeted sales quantity has increased. Okay, so when the selling quantity increases, it's a favorable variance. So it is favorable. Okay, so 59,37,500 is the favorable variance which the company has on account of increase in the market size. Okay, increase in the market size, which is purely a planning variance. So the sum and substance is only if the sales manager is able to make a variance, a favorable variance which is in excess of 59,37,500, both planning normal variances, okay, or any additional favorable variance with respect to the operational variance only, then he can be congratulated, or he can be promoted, or he can be incentive, the company can give any incentive to the manager. Okay, so this 59,37,500 is a planning variance, planning favorable variance, which for which he cannot be given the credit. Okay, it goes to the credit goes to the market because it's due to the increase in the market size. Is it clear? Okay, right. So we have done the planning variance. Now what do you have to do? Operational variance. Operational variance, under that a sales volume variance. Sales volume variance, how do you compute the sales volume variance? It is the difference between what? The budgeted quantity and actual quantity. I will take it as actual quantity minus budgeted quantity. Actual quantity minus budgeted quantity. Which budgeted quantity? It should be the revised budgeted quantity. Into standard margin. Okay, so we will start with the first model, that is 3000 watt PMPO. What is the actual quantity? Actual quantity is 1500 and revised budget quantity was also 1500 into rupees 6250. How much it comes? It comes to nil. Okay, variance is nil. Now next is 5000 watt. 5000 watt PMPO. What was the original, the actual quantity? Actual quantity was 600, but what is the budgeted quantity? 750. Okay, and how much is the standard margin? 23,750. See, what has actually happened is, when the market size has increased by 50%, he ought to have sold how many units? 750 units. But how many units actually he sold? He sold only 600 units. So is it a favorable variance or adverse variance? It's an adverse variance. Okay, so the adverse variance will be what? 150 into 23,750, that is 35,62,500 adverse. Is it clear? So you can write, okay, you can write, when the market size increased by 50%, the sales manager ought to have sold 750 units of the 5000 watt model. However, he could sell only how much? 600 units. Therefore, there is an adverse variance of rupees 35,62,500. Okay, for which Mr. K is accountable. Is it clear? So sales volume variance we have computed. Sales price variance is nil, because there is no variation in the selling price. There was variation which was offset with each other. Okay, so you can write a note also, another note on this, as the sales price variance was completely offset with each other, there is no sales price variance. Okay, sales price variance on net basis, right? Okay, now what do you have to do? There is one more requirement to compute the sales margin mix variance. Sales margin mix variance. Why you have to compute the sales margin mix variance? We know that sales margin mix variance will be there only if there are multiple products, that is more than one products, and the actual sales proportion of the products is different from what? The budgeted, from the budgeted sales proportion. Okay, now if you see here, what is the actual quantity? The actual quantity sold, we have 3000 watt, 1500, then 5000 watt, that is 600. So total you sold 2100 units. Okay, now when it is 2100 units, okay, there is a budgeted proportion. Okay, budgeted quantity. Which budget quantity? Revised budget quantity, because actual budget quantity, that is relevant only for computing the planning variance. Once you have computed the planning variance, then that is not relevant at all. Okay, so budgeted quantity, revised budgeted quantity is 1500 to 750. Is it clear? So what do you have to do? If you were selling, now what is the total here? It is 1500 plus 750, that is 2250. Okay, instead of 2250, you sold how much? 2100 units total. But when you sell 2100, you should have sold it in which proportion? In this proportion. Okay, what is this proportion? 2:1 proportion. So if you have sold the actual quantity in this 2:1 proportion itself, then there won't be what? There won't be any mix variance. But if the proportion has changed, then probably there will be mix variance. Okay, so you can write revised actual quantity in, or I will take it as actual quantity in standard proportion. In standard proportion. Certain students may commit a mistake by taking the original budget figures here or original budget ratio. No, that cannot be taken, because here you have revised the budget. Once you revise the budget, then that revised budget is your standard. Okay, fine. So here what do you have to do? Here it will be 2100 into 2 by 3, that is equal to 1400, and here 2100 into 1 by 3, that will become 700. Total will be 2100. Okay, so your actual quantity is 1500, vis-a-vis the standard proportion is 1400. Similarly, for 5000 model, it is 600 is to 700. So what will be there? There will be mixed variance. Okay, so mixed variance, sales margin mixed variance is equal to, how do you compute that? Okay, you have to take the revised quantity in standard proportion minus actual quantity into standard margin. into standard margin. Okay, so that will be start with 3000 watt. Okay, what is the revised quantity? 1400. 1400 minus 1500 into what is the standard margin? Standard margin is standard 6250. What do you say? Will it be a favorable or unfavorable? It should be unfavorable. Why? Because as per the standard, you ought to have sold only 1400 units of 3000. But how many you sold actually? You sold 1500. So it is a favorable variance. Okay. So 6 lakh. This is 100 rupees difference. So 6,25,000 favorable. Similarly, when you take 5000 watt, how many you ought to have sold? 700. How many did you sell actually? 600. So the difference is 100 into 23,750. Okay, so it will be 23 lakh 75,000. Tell me, is it favorable or adverse? It will be an adverse because you ought to have sold how many? 700. But how many did you actually sell? 600. So this is adverse. Is it clear? So net will be 23 lakh 75,000 minus 6 lakh 25,000. So 17 lakh 50,000 adverse. That is the net. It is adverse. Is it clear? So you know what is sales mix variance. So if you want, you can compute the sales quantity variance also, which is the difference between the sales volume variance and sales mix variance. But since it is not asked in the question, you are not supposed to compute, or you are not required to compute. But as a homework, if you want, you can do it. Okay, so that is the answers to the first part, A part. Now what is the second part? They say that comment briefly on the measurement of the case performance. Okay, now what do you have to say? Okay, so comment on performance of Mr. K. Okay, so here you can work out the variances. Sales variances have been worked out as under. Okay, in that first one is planning variances. In planning variances, the first thing is what? The sales planning variance, sales volume variance. Okay, sales volume variance. How much? Sales volume variance is 59 lakhs 37,500 rupees. 59 lakh 37,500. It is favorable. Now next is operational variance. Okay, operational variance. Again, sales volume variance. What is the sales volume variance here? Sales volume variance was 35 lakh 62,500. 35 lakh 62,500. 35 lakh 62,500. Is it favorable or adverse? It is adverse. So what is the net variance? Net variance is the difference between these two. Okay, so that is 59 lakh 37,500 minus 35 lakh 62,500. So that is 23 lakh 75,000 net. 23 lakh 75,000 net favorable. Okay, this is what he referred to in his email. What was he referred? This is this variance which he referred. Okay, so as far as Mr. K is concerned, he made a favorable net variance of how much? 23 lakh 75,000. But when you differentiate it into the planning and operational variance, you can find that actually this 23,75,000 is a net of, or after setting of figure of 15,37,500 favorable variance and 35,62,500 adverse variance. And for this 59,37,500 favorable variance, Mr. A cannot be held accountable, nor he can be given the credit. Okay, so for this he is not having any credit, because that is purely on account of change in the market size, for which or to which Mr. K doesn't have any control. Okay, whereas the operational variance is what which comes under his control, or he need to have looked into, and there he has made a adverse variance of 35,62,500. So can you say that he has he has done well, or his performance is better? No. Okay, he has actually underperformed, and which has resulted in an adverse variance of 35,62,500, not as he claimed to have earned a favorable variance of 23,75,000. Okay, so you can write, okay, Mr. K claims to have generated a net sales volume variance of rupees 23,75,000 favorable, rupees 23,75,000 favorable, full stop. However, on in-depth analysis, it can be understood that the actual operational variance on account of sales volume variance is rupees 35,62,500 adverse, is rupees 35,62,500 adverse. Okay, adverse. The net favorable variance is purely on account of planning sales volume variance of rupees 59,37,500 favorable, rupees 59,37,500 favorable, for which Mr. A cannot be given any credit, Thus, the performance of Mr. K has actually resulted in an adverse variance of adverse sales volume variance of rupees 35,62,500, rupees 35,62,500. Therefore, Mr. K has underperformed and has resulted in an adverse variance of rupees 35,62,500, as against his claim of an favorable variance of 23,75,000. Is it clear? So that is the comment you can give based on the performance of Mr. K, who is the sales manager. Okay, so we have done both the parts, and I think with this question we have done all the questions in the standard costing. Okay, so that's all we have done with the entire chapters in the SCM. Now one topic we have left out, that is the learning curve, which I will be taking next. Okay, and after that we will be dealing all the case studies given in the question as a separate section. Okay, in the study material as a separate case study section. We will do some, I think there are some 20 or 19-20 case studies. We will be doing each and every case study, and I will be giving you the lectures on that. Okay, you can practice those case studies. Then we will go to the RTPs and the solved question papers. Okay, so with this question, chapter 12 is over, right? Okay.